Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome everybody. This is going to be what we call a April market update. As a general rule, we give you a quarterly market update. We have a live event, and then we usually follow it up with video in case you can't make it. But with everything going on and so much activity happening out there in the markets and a lot of questions, I thought it'd be appropriate maybe to just do one for the month of April. Now, whether I do that for May, I don't know. We'll certainly do the next quarterly update, but certainly enough going on right now that I think it was appropriate. So with that, let me get started. And just as a reminder, as an airing of this show, I've been home now working remotely for 7 weeks. If you would have told me when I first started doing this, I was going to be talking and working from home 7 weeks later, I would have thought you were crazy. But absolutely unprecedented times. And it looks like, from what it looks like, I'm probably going to be here another 2-3 weeks. So with that, let me get started. So this is, you can see the major indexes as of April 30th, year to date. S&P 500 down 10%, the Dow down just under 15%, NASDAQ down less than 1%. Now we had in just that last 2 weeks of March alone, we watched the markets drop, better than 30%. And now in April, there's been a bounce back. Now I'm going to talk about that bounce back a little later on. But as it's settling right now, again, S&P down 10%. Now, the definition of a bear market is when you've had a greater than 20% correction that's lasted longer than 2 months. As of right now, I can't say that's technically true, but I think for all practical purposes, everybody believes it most likely will be. This is just the chart of the S&P 500 the last 2 years. You can see that it's pretty much where it was 2 years ago. We've had all of 19. It was rising, and you see of just recent this drop, and then this corresponding bounce back. But it's pretty much where it was 2 years ago. GDP growth. The last estimate we got from the Feds right now is showing that it was down almost 5%. Folks, and that was mostly driven by just the last 2 weeks of that month. I can't imagine what the second quarter is going to look like. I have to believe it's probably going to be in double digits. But as a general rule, the definition of a recession is when you've had 2 quarters in a row of negative GDP growth. And I don't think we can argue that we're clearly in recession right now. Crude oil, if anything, got the news there in April was this crude oil barrel going to negative territory. I mean, it got to almost negative $40 a barrel. How in the heck can that happen? Well, first of all, crude oil is supply and demand driven. You wouldn't have known this, but early out of college, I actually worked for an oil company in Chicago. And we had somebody on staff that basically all they did was trade oil futures. We had a number of retail outlets, and we needed oil, and so we'd buy these futures contracts to make sure we had what we needed when we needed it. So that was all supply and demand driven. But what a lot of people don't understand is there's speculators in the crude oil market too. These are people basically speculating on the price, hoping they buy a contract at one price and they can sell it at a higher price. Well, most typically as contracts get ready to be renewed for the month, if they want to get rid of their contracts, they can sell them off to people who actually want to receive the oil. Speculators don't want crude oil barrels showing up at their door. So what happened is you had this, because of the pandemic and the economic slowdown and fuel consumption being about half of what it was before the pandemic, and then you've got, couple this with Saudi Arabia and Russia kind of not slowing down their production, not cooperating and producing more supply when there was no demand for it. You literally had ships out in the ocean full of crude oil with no place to go. So all storage, maxed out or got to full capacity. People didn't want the oil. These speculators got to get rid of their contracts, and so they were paying the buyers to take it off their hands, if you can even imagine that. And that's what basically took it into negative territory. Now, once that all happened and they got rid of those contracts, then it got back up to normal. Now we're at, $20 a barrel. But folks, that's going to decimate the whole energy sector because they can't make money at that rate. I think I once heard that, it had to be around $50 a barrel for them to even make money. At this level, they're losing money. So I see a lot of small oil companies most likely going to be filing bankruptcies and such. U.S. consumer sentiment, as you can see, falling like a rock. And same thing with small business sentiment on the decrease. I've said this before, 87% of our GDP is consumer small business spending. So when they're not feeling good about what's going on in the economy, they're not spending. It's going to be a direct effect on their GDP. This is just the S&P 500 over the last 1 year, the PE ratio. That's the price to earnings, that ratio. Historically, the market has traded at about 17 times earnings. You can see it got up to about 24 times earnings, which is pretty frothy, but a lot said that was supportable because of low interest rates. But then after that panic selling, you can see it dropped down to about 19 times earnings. And now with a bounce back, it's around 20 times earnings. Still, for the most part, pretty frothy compared to historic standards. But you got to remember, this ratio is looking in a rearview mirror. It's looking at earnings the last 1 year, which haven't been too bad, right? If you look forward at what you think the earnings are going to be over the next year, I'm going to dare say that PE ratio is probably way much higher than what this is showing, which only simply says that there's going to be much more resistance on the upside, much more probably greater weight on the downside. This is just a volatility index. It's just basically what the market expects, the market expects the market's going to do in the next 30 days to the good or bad. All right. So a VIX rate of 20 means markets expect it to be 20% to the good or 20% to the bad. You can see with that panic selling, it got in excess of 80. And now has since, dropped down to about half of that, but still very, very volatile.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
We look forward to helping you plan to retire well.
I want to just take the time now to talk about some headwinds and some tailwinds, okay? First, I want to kind of talk about the tailwinds, okay? is this crash anything like the 1929 crash? You hear that in the news. They say it's going to take us back to the great. This is going to be just like the Great Depression. I think there's some reasons to believe that that's probably not true. One is this chart. As you can see, back in the 1929 crash, agriculture and manufacturing made up about 40% of the sectors. So when they got hit, it had a grave effect on the whole economy. Today, as you can see, we're much more diversified, and no one sector there is got a huge weighing. A second reason I don't think it looks like it's the 1929 crash is back in that crash, the feds took an opposite policy. They actually restricted credit, or the flow of money to these companies, which exasperated the issue. Today, the feds are throwing everything but the kitchen sink at this thing to make sure that credit is free flowing and that there's no restriction on credit policies. So, I think that's a big difference. A third main difference is the fact that back then it was economically fundamentally slowing down for economic reasons. Today, this shutdown is self-induced. The globe has literally shut itself down to try to get from this pandemic. So for all those reasons, I don't think this is similar to the 1929 crash. This is just a history of market ups and downs since the Great Depression. You can see in the red, that's when it went down more than 10%, and then showing you kind of how many months it stayed there. You can see that in 2000 through 2002, lost 45%. It was down for about 25 months. 2008, down 51%, lasted about 16 months. So the good news here is that when we do get into recession, they're typically not long periods of time. Some of the major financial institutions are calling for a V-shaped recovery. As you can see, they think it looks really bad for the second quarter, and they're thinking things are going to be up by third and fourth quarter. So you hear a lot about that in the news, this V-shaped recovery. It's going to be a big down and then a very quick up. And a lot of good reasons why they believe that is because economic conditions were fairly good before we shut down. So once we start things back up, should it not get back to where it was fairly quickly? Unemployment, as of this recording, it was like at 20%, very, very high. They're likening this to the unemployment back in the Great Depression. That's why they keep referring to that, I think. But a lot of these financial institutions believe that we'll get back to the low unemployment we had prior to the pandemic, probably by second year. PricewaterhouseCoopers surveyed leaders from a cross-section of industries and trying to ask them how quickly they think they're going to get things back to where they were. You can see better than 60% believe that'll be in probably within 3 months, they'll be back to where they were, business as usual, as you say. A lot will ask what's going to happen with real estate. You can see based on this chart, better than 50% of the people have greater than 50% equity in their homes today. That's a good thing. I think this real estate market has been mostly driven by supply and demand, which is a good thing. And being that so many people are in really good shape with their homes, I don't think we're going to see the big negative effects with real estate like we did maybe 2008. All right, well, those are some of the tailwinds, but let's talk about some of the headwinds, okay? Some of the things that might put a little bit more downward pressure on the market going the other way. First of all, I talked to you earlier about the feds. They took their balance sheet from $1 trillion after the last recession. They raised it to $4.5 trillion with all that quantitative easing they were doing. And where do you think most of that money went? Well, how much do you think corporate debt went up by during that period of time? You guessed it, about $4 trillion. So what were corporations doing with that money? Well, based on this chart, they've basically been the net buyers of equity, or basically buying their own stock. That's what's been a good driving factor in the market continue going up. Everybody else, you can see based on that red line, have been zero net buyers of equities. So you got corporations being a main driver of the market, buying their own stock. But what's going to happen? if you didn't know this, with this money that they're giving corporations, if any of them take the money from the government to get through this pandemic, they are not going to be able to do what you call buybacks for 1 year after they pay the loans back. So you take who's been a really good driver of the market or buyers of stock, and you take them out of the equation now. What's that going to do to the market? I talked about, all that money going on corporate balance sheets. Well, I've said this before, and I'll say it again. What I thought was going to be the next bubble to burst in our markets was corporate debt, because it was so high. And what we had was a gradual downgrade of corporate debt. Meaning when they're grading a corporation, they're trying to grade it according to its creditworthiness or ability to pay its loans. So as that gets downgraded, that kind of becomes a concern. I said this before, I'll say it again. All I could see happening was any kind of an economic slowdown, and how was that going to affect corporations, and was that going to necessarily mean more bankruptcies? And I'm going to dare say so. Just that energy sector alone, 12% of the corporate bond market is made up of energy or oil companies. So if that sector gets destroyed and you get higher default rates there, you can see what can happen. So you get companies filing bankruptcy, you see default rates rise. What does that do? Why is that bad? Well, what happens is banks start to they have to have more on reserve. They start restricting the money they loan, and that then has kind of a kind of a domino effect, because then that slows down the economy as well. Now, interestingly enough, in the first quarter, there was over 700 companies. You look back, this didn't happen since 2008, where so many companies were basically being downgraded as far as their creditworthiness. Just in the month of April alone, and I have this stat here, another 531 companies. So that's almost 1,300 companies been downgraded just since the first of the year. And as we get into the second quarter, I dare say that number is going to increase again. Interesting. This is just a chart that shows where we've had big gains associated, if you can see in the green, big gains associated with high optimism. And then what's represented in that red box is big losses associated with low optimism. But where we find ourselves today, it's where that dot is that the yellow is pointing to. Basically, you've got the market doing very well, but very little optimism. We are literally in uncharted territory, very much outside the norm, as you can see. April was a paradox. Just look at the statistics here. You got air travel down 96%. Hotel occupancy is down 68%. Box office receipts are down 100%. New home sales down 15%. Gasoline consumption down 44%. Durable goods in March alone were down 14%. And over 28 million Americans filed for jobless claims in the last 6 weeks. So with all that, economic negative activity, what is the market doing? S&P up 13% in the month of April. The biggest monthly gain since 1987. The best April they've seen in 82 years. What a disconnect, folks. Now, what is that? The market doesn't necessarily move with the economy in the short run. All right. The market is trying to speculate as to what they think it's going to do in the future. So this is a lot of what I would call net buyers of stocks in the month of April that think that we're going to get on the other side of this pandemic and it's going to happen quickly and market's going to rebound and do well. Again, highly speculative. I don't think that the numbers are typically out yet that can make that case.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time, we'll have reports that show us the percentage of assets currently in high-risk vehicles, as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
Here's why I think things are going to not come back as fast as people like to think they would. This is a poll that CBS did. They said if the restrictions were lifted right now, all right, how many would be willing to go into a bar or restaurant? Believe it or not, 71% said no. Get on an airplane, 85% said no. Attend a large event, 87% said no. I heard a commentary from somebody, and I think this is going to hold very true. They said, when things open up, you're probably going to see 1/3 of the people get out there right away. All right, I even see it. My kids seem to be like that. They just no fear, they're going to get right back to normal real quickly. The other 2/3 are going to sit back and see how the 1/3 do. Right, we're going to see, okay, how are they doing? Is this thing spiking back up? Is it safe? And then you're going to see another 1/3 slowly get, integrate once they see the coast is clear. You're going to have another third, though, that they might have some health issues. They might be a little bit older, a little bit more concerned. This is still a deadly threat to them if they get it, are going to be a little less reluctant to get in. But we'll eventually, once the coast is very clear, maybe we have a vaccine, maybe we have a treatment. But to say the least, just that things are lifted right now, we're all going to get back to normal in a very short period of time. I don't think it's going to be the case, especially for, large gatherings and getting on planes and traveling and doing all the like. So we may get to that place where things turn around and it's safe, but it's going to be a slow recovery. I talked about this in the quarterly market update. There's really 3 stages to a bear market. You got the first stage, which is that panic selling. Now, that's certainly what we saw that last 2 weeks of April, losing 30% in a 2-week period of time. That's panic selling, people just taking the bad news and getting out. But then you have the second stage, which is this, buying the dip. They think it's gotten way down. This is a good time to get in. And, they buy the dip, and then you got those that are taking the profits, and it kind of goes back and forth. And I liken this bounce back to a little of that. People thought that hit rock bottom. They think they're hoping for a quick recovery. I'm getting in. But then, as economic news comes out and this wanes on people, especially as we get here into the second quarter, you're going to see that retest that bottom and most likely, hit that low and some. And I'll talk about that next. But that's when people start getting a little bit discouraged. But the bottom of it, the final stage of a bear market, is when somebody gets to a place where, or most people get to a place where all optimism is out the door. They don't think it's ever going to come back. And that's typically when you've hit the bottom. Right now, that is certainly not where we find ourselves. So I kind of plotting the course here, and I'm saying we're still probably right in the middle of this bear market. People are buying the dip, taking profits. We are certainly not at the bottom. Now, when it has hit a bottom, and this is going back charting when the market has lost more than 37% in the past, okay? When it's hit a bottom, there's always been a corresponding bounce back like we've just seen recently here in April. And so when on average has it returned to its bottom or retested the bottom? In all these cases here, it averaged about 137 days. So here we've had a bounce back. Now we're about a month into this. Probably within the next two months, we're probably going to see this, especially as this economic data comes out and more bad news, you're probably going to see it retest those bottoms we saw in March. Now, will that be a great opportunity? Depends. If we retest those bottoms and we get any really good news on the pandemic front, like maybe we do have a reliable treatment. I just heard of one recently that just went through FDA. I think it was called Remdesivir or something like that, made by Gilead Sciences. But if that does end up proving out to be a treatment, and we're also at the bottom of a market due to economic activity, I dare say that would be a good sign of maybe getting back in. So with that, I call this our roadmap right now. What do we want to do? Well, I want to stay defensive. That's going to be our posture for most of you. There's more evidence that we're probably going to have some headwinds right now than we're going to have those tailwinds. So we want to stay defensive. Want to look for that final stage of the bear market. Not going to be able to time it perfectly, but I dare say if this market drops to anywhere between 40 and 50% if it's high, I would dare say we're approaching the bottom. Good news on the pandemic front, again, treatment, vaccine, any of that. Give me those two things, and that's going to be a great time to just dial up the risk exposure again. Okay. Now, I wouldn't be an advocate for any of our clients to be all in, right? But we certainly want to get a little bit more equity exposure back in their portfolios to take advantage of that upside. So, and again, for all the reasons, all the stimulus that's gone out there, by the time we come to the end of this, we got interest rates at all-time lows, oil prices all-time lows. With all of that, it's going to be a great making for some great opportunity on the other side. I just want to show you this chart in ending. This is showing you on the left. It kind of shows you where the markets have dropped. You can see like at the bottom where it's dropped 50% or more. Within 1 year, the market is done 53% to the upside. So huge opportunity on the other side of this to take advantage of that if we can find the right time. Now, if we're wrong, and there is this V-shaped recovery, we never do test the bottoms, then no harm because we've had a defensive posture. We'll see that when it comes, and we'll make the adjustments accordingly. But I think most clients right now would rather, dare say, preserve what they have and not speculate too much, and then try to take advantage of opportunity when you can. So with that, I just want to thank you for participating in this. If we can be of any help, again, I'm working remotely from home. We're all of us at Centennial Wealth are still employed, working here to help you, service you in any way we can. So if you need any help with anything, give us a call. If you have any questions, then certainly give us a call. We appreciate it. Again, thank you very much. I'll talk to you soon.